The moment silver moved beyond the $100 mark, the shift was immediate and unmistakable. What had been unfolding as a powerful bull run crossed into a new phase defined by speed rather than anticipation. The host frames this move as something he did not expect to see so soon, emphasizing not disbelief but surprise at the pace. Silver had been rising, but this acceleration forced a reassessment of timelines rather than direction. The price action is presented as a confirmation rather than a contradiction of the existing trend. This was not described as a blow-off top or temporary distortion. Instead, it marked a continuation of momentum that had already been building. The significance lies in how quickly a psychological threshold was breached. Triple-digit silver had long been discussed as a future possibility. Its arrival altered the tone of the market conversation. From the outset, the framing resists the idea of a singular cause or a one-day anomaly. The surge is positioned as evidence that underlying forces were already in motion and have now become visible in price. The host makes clear that this level is not viewed as an endpoint. It is treated as a transition point, signaling that prior assumptions about resistance and pacing may no longer apply. This opening establishes the documentary's central premise. Silver's move above $100 is not the story by itself. The story is what that move reveals about the current phase of the market. Expectations are recalibrated upward, not through hype, but through acknowledgement that prior ceilings have failed faster than anticipated. The emphasis remains on trajectory, not celebration. The tone is deliberate and restrained. There's no declaration of final victory or completion. Instead, the price milestone serves as an entry point into a broader examination of performance, drivers, and implications that extend beyond a single number on a screen. Silver's performance is presented with specific attention to scale and relative strength. At the time discussed, silver is up 6.49%, trading at approximately $102.54 per ounce, and reaching a new all-time high of $102.67. These figures are not introduced as abstract statistics, but as confirmation of a decisive breakout. The movement is framed as both rapid and sustained within the session, reinforcing the sense that the market has entered a different intensity level. What distinguishes this move is not only the price itself, but silver's outperformance compared to other metals. The host emphasizes that silver is leading rather than following, asserting itself as the strongest performer in the group at that moment. This leadership role matters because silver has historically been more volatile, often lagging during periods when other metals rise first. In this instance, that pattern is reversed. The percentage gain is highlighted to illustrate momentum rather than speculation. A move of this size in a single period signals aggressive participation and a willingness by buyers to transact at progressively higher levels without waiting for pullbacks. The price does not drift upward, it pushes. That distinction is central to how the performance is interpreted. The all-time high is treated as a factual milestone, not as a climax. By emphasizing that the previous ceiling has already been surpassed, the discussion removes the psychological anchor of past resistance. Once that anchor is gone, the market is no longer constrained by recent reference points, which can accelerate further movement. This section establishes silver as the focal point of the broader metal surge. Its performance is not framed as an echo of gold or a derivative reaction. Instead, silver is positioned as the clearest signal that the current phase of the bull run is being driven by forces strong enough to overwhelm historical hesitation. Silver's surge is placed alongside a broader advance across the precious metals complex. Gold is described as moving toward the $5,000 per ounce level, reaching new all-time highs in the process. Its rise provides contextual confirmation that the move in silver is not occurring in isolation, but within a market environment where multiple metals are being repriced upward simultaneously. Platinum is also identified as reaching a new all-time high, trading around $2,179 per ounce. Its performance reinforces the sense that industrial and precious metals are both experiencing upward pressure. Unlike silver, which carries both monetary and industrial narratives, platinum's rise underscores that supply and demand dynamics are affecting a wider range of materials. Palladium is noted as breaking above the $2,000 threshold, marking a significant recovery and continuation of strength. This move is presented as part of the same upward revaluation rather than as a separate story. The crossing of a round number barrier is treated as evidence of momentum rather than speculation. Rhodium is also increasing, adding to the picture of a sector-wide advance. Although it receives less detailed discussion, its inclusion serves to complete the pattern. Price strength is not confined to one or two metals. The entire complex is moving higher, each at its own pace but in the same direction. By situating silver within this wider context, the narrative avoids attributing its rise to a narrow cause. The concurrent all-time highs across metals suggest systemic drivers rather than isolated demand. Silver's leadership stands out more clearly when viewed against this backdrop, but it is reinforced, not contradicted, by the strength elsewhere in the market. Mainstream explanations for the surge focus on familiar themes that tend to surface during periods of sharp price movement. Major media outlets attribute the rise in silver to robust demand combined with investors seeking safe haven assets. In this framing, silver benefits from the same conditions that have historically driven flows into precious metals during times of uncertainty. Geopolitical turmoil is cited as a central backdrop. Heightened global tension is presented as a catalyst that pushes capital toward assets perceived as protective rather than productive. Silver, alongside gold, is placed within this category, valued not for yield, but for its role as a store that exists outside financial systems exposed to political risk. Expectations of lower interest rates are also emphasized as a contributing factor. In this explanation, the anticipated easing of monetary conditions reduces the opportunity cost of holding non-yielding assets. As rate expectations shift, metals become more attractive relative to cash or fixed income instruments, supporting higher prices. These explanations are presented as additive rather than exclusive. Demand, uncertainty, and rate expectations are shown interacting rather than acting independently. The result is a narrative in which silver's rise appears as a rational response to macroeconomic signals, widely recognized by market participants. At the same time, the documentary tone remains neutral toward these explanations. They are reported as prevailing interpretations, not definitive conclusions. The emphasis is on what is being said in public discourse, setting the stage for later sections that introduce alternative or less conventional drivers without dismissing the mainstream view. Alongside demand narratives and macroeconomic explanations, the discussion identifies physical constraints within the silver market itself. Challenges in refining are cited as one factor contributing to upward price pressure. These challenges limit how quickly raw material can be converted into usable supply, creating bottlenecks that persist even when prices rise. Persistent supply shortages are described as an ongoing condition rather than a temporary disruption. The market is not portrayed as one that can quickly respond to increased demand through expanded output. Instead, supply is framed as structurally constrained, reinforcing the sensitivity of prices to changes in buying behavior. These limitations operate quietly in the background. Unlike geopolitical headlines or interest rate announcements, refining capacity and supply availability do not shift overnight. Their influence is cumulative, building pressure that becomes visible only when demand accelerates enough to expose the imbalance. By introducing these factors, the narrative broadens beyond sentiment-driven explanations. Price is shown responding not only to investor psychology, but to physical realities that govern how much silver can actually reach the market. The implication is not that shortages alone caused the surge, but that they amplified its effect. This section remains strictly descriptive. It does not project timelines or outcomes. It establishes that constraints exist and that they are persistent, contributing to an environment where sharp price movements become more likely once momentum begins. A different explanation is introduced through the perspective of institutional behavior. Josh Philip Farr from Scottsdale is cited as suggesting that a major driver behind the move in silver is pressure exerted by JP Morgan on China. Within a context where China continues to buy the metal regardless, this framing shifts attention away from retail investors and toward large-scale strategic actors. In this account, the focus is not on speculative enthusiasm, but on accumulation. China's continued purchasing is described as persistent rather than reactive, indicating demand that is not easily discouraged by price increases. The implication is that buying at this level reflects necessity or strategy rather than short-term opportunity. The discussion extends beyond a single country. Other nations are also described as building physical stockpiles, reinforcing the idea that state-level actors are participating directly in the market. This form of demand differs fundamentally from paper trading or short-term positioning. It involves the removal of physical metal from circulation. Institutional and sovereign buying changes the character of the market. When large entities acquire physical silver, supply tightens in a way that cannot be quickly reversed. Unlike financial positions, physical holdings are not easily unwound without deliberate policy decisions. This introduces a degree of rigidity into supply-demand dynamics. By emphasizing institutional influence, the narrative reframes the price surge as structurally driven rather than emotionally driven. Retail speculation is not presented as the primary force. Instead, the market is depicted as responding to actions taken by entities with long horizons and substantial capacity, altering the balance in ways that individual participants cannot offset. The concept of a structural deficit is used to explain why these pressures have continued to build over time. The silver market is described as being in its 6th consecutive year of such a deficit, specifically tied to industrial use. This means that demand for physical silver has consistently exceeded available supply, not as an anomaly, but as a recurring condition. A structural deficit differs from a short-term imbalance. It does not rely on temporary disruptions or cyclical swings. Instead, it reflects a persistent gap between how much silver is needed and how much is produced and delivered. Over multiple years, that gap accumulates stress within the system. Industrial demand plays a central role in this framing. Silver is not treated solely as a financial asset, but as a material required for ongoing use. When industrial consumption remains high across successive years, available inventories are steadily drawn down unless production increases enough to compensate. The significance of a sixth consecutive year lies in durability. 1 year of deficit might be absorbed through existing stockpiles. Multiple years indicate that those buffers are being depleted or have already been reduced. This leaves the market more exposed to price volatility when additional demand emerges. By introducing the structural deficit at this point, the narrative connects earlier themes. Institutional buying, supply constraints, and industrial use converge into a single explanation for why price moves can become abrupt. The deficit does not predict price, but it explains vulnerability. Future expectations are presented with both confidence and restraint. The host states his belief that the bull run in silver will continue, extending beyond the current price levels rather than stalling after the 100 milestone. His outlook includes the possibility of silver reaching $150 per ounce and potentially even $200, framing these figures as extensions of the same forces already in motion rather than as speculative extremes. At the same time, this forward view is not linear. The host explicitly acknowledges the likelihood of sharp reversals along the way. A potential drop back toward $50 per ounce later in the year is mentioned, drawing on the understanding that silver has historically experienced violent corrections, even within long-term upward trends. This dual framing resists the idea of smooth progression. The inclusion of both upside targets and downside risk is central to how the prediction is constructed. The host does not present higher prices as inevitable in the short term. Instead, he emphasizes volatility as a defining feature of silver's behavior. Large advances and deep pullbacks are treated as compatible, not contradictory. By referencing past market behavior, the outlook is grounded in pattern recognition rather than certainty. The suggestion of a substantial pullback does not negate the bullish thesis. It reinforces the idea that price movement in silver tends to overshoot in both directions before settling into a longer-term trajectory. This section positions expectations as conditional rather than declarative. The future is framed as dynamic, shaped by the same structural pressures already discussed, but expressed through a market known for abrupt and emotionally challenging moves. The host draws a clear distinction between viewing silver as an investment and viewing it as a preserver of wealth. This distinction is central to how the price movement is interpreted. Silver's sharp advances and sudden declines are presented as evidence that it does not function well as a conventional investment vehicle measured by stability or predictable returns. Instead, silver is framed as something held across time rather than traded for performance. Its role is not to generate income or to compound through appreciation alone, but to maintain purchasing power through periods of disruption and monetary change. In this view, volatility is not a flaw, but a characteristic that must be accepted. The emphasis on wealth preservation reframes how gains and losses are experienced. Short-term price swings, whether upward or downward, are treated as secondary to long-term holding. The focus shifts away from timing and toward endurance. This perspective aligns with the broader discussion of structural deficits and institutional accumulation. By rejecting the language of investment, the host removes expectations of smooth growth or managed risk. Silver is not positioned as a tool for optimization, but as a safeguard. Its value lies in its ability to exist outside systems that are subject to policy shifts or financial engineering. This framing serves as a stabilizing lens through which the preceding volatility can be understood. Rather than contradicting the possibility of sharp corrections, it absorbs them, presenting silver's role as something that persists regardless of market turbulence. The documentary closes by returning to a comparative measure that links silver's rise to the broader metals landscape. The gold to silver ratio is noted as having dropped below 49, settling around 48 toward 58. This level is described as one not seen in a long time, marking a significant shift in relative valuation between the two metals. The ratio functions as a contextual indicator rather than a prediction. A lower ratio reflects silver strengthening faster than gold, reinforcing earlier observations about silver's leadership within the current market phase. It provides a numerical expression of the outperformance already discussed in price terms. By highlighting this ratio at the conclusion, the narrative ties together multiple strands. Silver's surge, institutional accumulation, structural deficits, and broad-based metals strength converge into a single comparative frame. The ratio does not explain causation, but it confirms that silver's move is not marginal or isolated. The emphasis remains observational. No target or correction is inferred from the ratio itself. Its significance lies in rarity and timing. Reaching such a level at a moment when multiple metals are posting all-time highs underscores the magnitude of the shift underway. The documentary ends without finality. The ratio, like the price, is a snapshot of a moving system. What it records is not completion, but transition. Silver's position relative to gold signals that the market has already changed, even as its next phase remains unresolved.